What's happening, my friends? Hey, we are live. All right. So, welcome to the exam breakdown. Today, we are going through our NMLS exam prep content as I try to help y'all practice and prepare. Think about a couple of things as you are studying for this mortgage originators licensing examination all over the United States, anywhere, everywhere, anywhere, anytime. This is the stuff that's going to work. It's going to work. It's going to work. I'm telling you. My name is D. Kumar. It is an absolute pleasure and an honor to be here with you, helping you get through this and beyond. My goal is to make sure that we are priming at the pump new professionals getting into the business, making sure that you guys get started right, and then making sure that you're doing your job and making the money and doing everything you're supposed to be doing in order to grow and serve you and yours as you know you want to. So my goal today is to help you study, take a little bit of the edge off during your lunch break. We're going to go through a couple of things. We're trying a format today where we're going to be going through some questions that students have asked me over the years, and I've got a lot of technical experience with examinations of this type, many different varieties of exams, many different disciplines, many different topics, but real estate happens to be something that I'm pretty good at, and I've trained tens of thousands of people doing this exactly where you are, looking to get your license, looking to get through this examination. And this particular examination is a bit of a challenge in the sense that it's tough. Number one, you see a lot of students learn and prep for this, and then sort of, if they fail, if they don't get the mark, then they have to wait 30 days. So unlike a lot of other exams where you can kind of reschedule another makeup, take the exam quickly where the material's still fresh, in this particular course, in this discipline, you're going to have to wait 30 days. As you know, if you fail, then if you take it again and fail again, you're going to have to wait another 30 days. And then the third failed attempt, you're going to have to wait 6 months before you can go ahead and get this. So this is a tricky test. And there's sort of this benchmark as to why people need to take this examination. And because of that, it can cause some anxiety when it comes down to it. So I'm just looking over my shoulder, making sure we're looking good. Everything is sounding great and everything else. All right. So once again, the goal is to do that. Now, right on the outset, I wanted to talk about a recent, one of our subscribers had a comment, and I wanted to kind of address that comment. I'll post it up later when we do it, but it was from at Lisa Keys 3919. And this was just about yesterday. And there was a video that I just put out. I did a live video. I believe I did it. Maybe it was last week. So it was about sort of the mortgage originators topics. And there was a question that came up about the loan estimate, and if the loan estimate the origination fees had to be 100% accurate, and they could not change. And then in that same video, shortly right after, I'd mentioned that there could be changed circumstances, and there's always determinate, and I wasn't really getting into the changed circumstances piece. And I just wanted to read her comment, and I just wanted to kind of address that. I appreciate your comment, by the way, but I wanted to talk about it while we were live so I can clear it up and make sure that there was no other confusion. And you've also inspired me to do a video on changed circumstances just to make sure. But I did mention changed circumstances in that video. It was like around the minute 21:20 was the marker, somewhere around there. So go back there, Lisa, and check that out. So she said, well, I have a slight issue with what you said about loan estimates not changing. They can change slightly, but not more than 10%. You need to explain about no tolerance, zero tolerance, and 10% tolerance fees. What doesn't change at all is the CD. Now, I'm going to explain to you one thing. So first off, when an originator presents a fee of what the origination charges are going to be, in the regulatory framework, what is paramount of interest, and the reason why regulators move towards the LE, one of the big problems prior to the economic collapse, and I was in the industry, I helped shape a lot of the educational pieces. I've sat on committees before. I've also sat with banks that are getting audited by their various division of banks and division of insurances, and I've also looked at the regulator side as well. So I have a lot of experience sort of on all of it. What we've found and what made sense to me, the problem that existed prior to was that with fees, originators would quote a a fee, an origination fee, and then they would change it in the middle of the entire transaction, unbeknownst many times to the consumer. And this happened, this was a pervasive practice. Wasn't like a few times. This happened like all the time. It'd be like, hey, I'm going to charge you $500 for processing fees or application fees. And then later they would just kick it up to $900. And so then when the consumer would get their final HUD-1 settlement statement, this was before the closing disclosure, what would happen is they would look through it and the fees would change. And they would never compare the original loan estimate because nobody took the loan estimate seriously, as everybody, including the industry, played it off as it's subject to change, things can change. And as things did change many times, consumers overpaid all the time. So one of the big problems that they were trying to fix was that. Now, with that being said, the underlying baseline of what everything is about is doing a loan in good faith. That's the big key phrase, good faith. So if you do the loan in good faith and you say you're going to charge me 1% in origination fees and $500 in application fees, then the regulators are looking to make sure that regardless of changed circumstances, that you're not making a loan in bad faith. And that's a critical issue. It's all about that. Now, I have seen banks get nailed with huge penalties and fines because they were doing something like this with changed circumstances, but they were doing loans in bad faith. So look that up. Go to the CSBS website, all of you guys, and check out doing loans in bad faith. If you see that, what happens is the regulators and enforcers are looking for patterns of practice, and they are trying to figure out if loan originators are still hiding behind changed circumstances, changing fees and charging more. Now, why did they put those tolerances? We'll talk about those later. That's a whole other lecture. But the tolerances are if things do change. However, loan origination fees cannot change. There is no cumulative 10% change that can go on with loan origination fees. Other fees, yes, not origination fees. So there are changed circumstances, and you can redisclose loan estimates 4 days prior to closing, and the CD cannot change once it's been finalized. But we have to make sure that all loans are being done in good faith. I'll shoot a video and explain the cumulative tolerances, what can change, what are changed circumstances, and all of that stuff, as I'm fairly confident you're going to see something like that on your examination. But I wanted to address that because there can be confusion about that. And getting into the industry, you have to make loans in good faith to the positive outcome of the consumer and not to the detriment of them just because of a technicality of changed circumstances. So when I approach teaching this stuff, I many times will say, hey, your origination fees cannot change. And then I'll say, hey, there can be changed circumstances. Those things do happen. But I want you to make sure that you understand that all loans have to be made in good faith to the positive outcome of the consumer. So just on the outset, thank you for that question, though. It was a great question, and we got into the finer aspects of it. So I understand exactly where you're coming from and what you're learning, and I want to make sure that I'm helping to complement that to help you get through the exam to make sure it works out. But once you get in the field, yes, things can change and circumstances can change, but all loans, no matter what is going on, has to be done in good faith to the positive outcome of the consumer. And that's what regulators are looking for when it comes to these mega changes inside of LEs and CDs and stuff. And regulators know, hey, look, things can change and their fees can increase or decrease, but they shouldn't increase for no arbitrary reason. The amount of workload hasn't changed. If I decided to charge you $500 for processing and then miraculously I changed it to $900, that was one of the big problems that they were like kicking around when they passed the SAFE Act and everything else was going on. Those were the discussions in those back rooms as far as how do we figure out a way to help the consumer benefit. All right. So with that being said, again, thank you. That was a great question, and it bared a lot of explanation. We can still get into it, and I promise I'll do a video when time permits us about changed circumstances. So thank you very much for that. Thanks for being a subscriber. I do appreciate it. Good luck with your exams. All right, so let's hit this. What I want to do is I want to get into some questions and answers, and I don't want to. This is going to be a relatively brief session. We're going to go from now till about a little before 12:45 is the goal, always to get us out with the exam breakdown, just to get us in and talk about it. Now, with these questions, however, what I want to do is I want to approach Q&A. Hey, there I am. I want to approach Q&A and make sure that we're just talking about some of these popular questions. And these are going to be relevant. You're going to see these come up on examinations. So let's do this. The first question that I would receive from some students, and again, we've accumulated these, is what is the difference, so what is the difference between front end and back end DTI? DTI for y'all, so it stands for debt to income ratio. And how do I calculate these? On your examinations, you will need to learn the calculations, the math for DTIs. And you're going to need to know the DTI calculations for a couple of different ones. For qualifying for an FHA loan, qualifying potentially the total debt ratio for a VA loan potentially, what could be the debt to income ratio for a conforming conventional loan, and such. And again, one of the other things that we will learn in the courses and on the exam, you do need to be able to sort of resuscitate, is what is the DTI for the ATR rule, which is 43% back end. And so you want to know these numbers. They're going to ask you like 3143, 41 total back end, that's VA, and you want to know the ATR rule and 43% back end ratio. I just want to make sure you start to learn those. They're going to be on there. I'm not going to jump into them head first on this particular training, but they will be there. All right. So the difference between the front end and the back end DTI is the front end DTI includes housing expenses. So front end, or the top number, sometimes they'll refer to it as, is the housing expenses, PITI and HOA. So it depends if you're buying a condo as well, the principal, interest, taxes, and insurance divided by the gross monthly income. And the back end ratio, or the DTI, includes all monthly debt divided by the gross monthly income, all monthly debt, including the housing expense. So front end ratio is only housing, and then the back end ratio is total debt, total reported debt, by the way. Examples: gross monthly income of $5,000, the monthly housing expense, the principal, interest, taxes, insurance is $1,500. Other monthly debt payments, $500 for a car loan, credit card minimum payments, and student loans. Now, one of the things that you might see in practice also is that installment debt versus revolving debt. So installment debt is like car loans, student loans. They have some finality to them, right? Installment debt. You're making installment payments and ultimately you're done paying them. Revolving debt is you utilize it, you pay it down or pay it off, you reutilize it. So it's constantly revolving, right? But installment debt payments of less than 10 payments remaining, many underwriters have it the option, if they want to, in the conforming loan markets and in other loan markets, to eliminate that from the housing ratios, the debt ratios, so that you don't need to use those. So like, let's say if you have 5 payments left of a lease or something like that, well, they can not include those in your debt to income ratios. That is an opportunity that the underwriter can do. Now, if you're fairly cash strained, and the underwriter can use those as a negative factor, so they can decide if they want to utilize shorter installment debt. The examples that we gave you here, the front end would be the housing expense divided by the gross monthly income, or $1,500 divided by $5,000, and that gives you a 30% housing ratio. I'm going to just grab a marker here so I can mark this up as well if I need to. Right, all right, so there is that. And then the back end, the total debt is the total expenses divided by the gross monthly income. Now, the total expenses were an additional $500, and we add that to the $1,500 of PITI, and we do the division, and we get 40%. So the ratios are, in this example, 30-40, right? So 30-40. That's the way that this is expressed. Now, you might have to be able to do something like this for a qualifying an applicant for an FHA loan, which is a 3143 back end, 3143. So you want to make sure that they're in line. So in this particular case, they would be in line. And then, a 2836 is the conforming, and then 41 is the total for a VA loan. So you want to remember these. Other qualifications, sometimes you might look to the USDA, and the USDA is a little bit unique because it doesn't look at ratios. The USDA is looking at the average median income to qualify. So you're looking for this, that your income cannot exceed, I believe it's 100, I got to check, I'm pretty sure it is. I believe it's 115% of the AMI. They use average area median income for the USDA loans. So again, you want to be able to understand qualifications for FHA, I'll write here, VA, conforming, conventional, and you want to know USDA. And if you start getting these numbers under your fingertips and kind of understanding how to calculate DTIs, fronts and backs, then you should be good to go. Practice question here. Let me get out of your way. We've got, which statement about front end and back end DTI is correct? Letter A, front end DTI includes monthly housing expenses, PITI, divided by gross monthly income. Letter B, back-end DTI includes only monthly housing expenses, PITI, divided by gross monthly income. Letter C, both DTI ratios exclude housing expenses when determining repayment ability. Letter D, front-end DTI includes all debt obligations divided by net monthly income. And the answer? Letter A, front-end DTI includes monthly housing expenses, principal, interest, taxes, and insurance, and HOA, by the way, if there's a condo association, divided by gross monthly income. So just understanding the basics here is useful. Hey, Kate, really cool backgrounds on the questions. I like the money. I like the money a lot. All right, next question in our Q&A, another popular question that has come up, is what are the key characteristics of a qualified mortgage? That's a nice way of putting it. Usually the question with students is, what's a QM loan? That's usually the question. Qualified mortgages are definitely things that you tend to see on exams. You want to know a little bit about these. And so what is a qualified mortgage? Qualified mortgages are a loan that meets specific standards designed to protect borrowers from risky loan features. So again, risky loan features is what we are trying to avoid. It's one of the things that got us into a lot of hot water in the 2008 collapse, the economic crisis that we went into because of the mortgage lending sector. And it ensures lenders assess a borrower's ability to repay the loan. See, prior to that, the ability to repay a loan was really never considered. It wasn't a huge metric. We were looking at collateral-based lending, or we were looking at stated income based off of credit scores, and all of these other things where the ability to repay a loan really wasn't a huge thing with a lot of these new financial products that they had. So like stated income, stated assets, if you had high credit scores, and all of these other types of loans where the verification of if could they pay the loan back existed, didn't prior to. So they sort of homogenized it and they sort of made up rules at that point. They codified everything. So that's what happened post 2008. A QM loan must meet certain criteria, and what they've determined is such as limits on debt to income ratio, which we just talked about. And for a qualified mortgage, the max back end is 43%. Now listen, does it mean that if the debt to income ratio exceeds 43% that it doesn't qualify? No, absolutely not. Lenders are given a lot of latitude based off of other compensating factors that allow an originator to make a loan to a consumer so long as underwriting understands and feels very confidently that the loan will be paid back, right? So can we exceed 43 back end? Yes, just so you know. Are you going to be violating the law if you exceed 43 back end as a lender? No. But you just have to make sure that the ability to repay has been established. And what were the compensating factors to the positive side? Maybe they had a lot of cash savings. Maybe they had, a long history of perfect mortgage payments, paying other lenders. So like all of these things are compensating factors. Maybe they have a huge length of employment, consistency, and history, right? So all of these factors are going to go in to let an underwriter go, yeah, I'm going to make a judgment on this loan. Even though there could be a problem, I just want to make sure that they can repay the loan, and then we should be good, right? So like those are all of the things that we're looking for. So you can exceed 43 back ends, not a big deal, but you want to remember 43 for a qualified mortgage. Now, prohibitions on risky loan features. Some of the risky loan vocab phrases you want to know for your exam. negative amortization, interest-only payments, and caps on fees and points. So we cannot exceed 3 points on transactions. With VA loans, for example, you cannot exceed 1 point in origination fees. So like there are caps on some of these fees. Back in the day, states would cap fees, and some states could be all over the place where it came down to it. All right, let's keep going. Note here that the QM rules were established under the Dodd-Frank Wall Street Reform Act and Consumer Protection Act and enforced by the CFPB, the Consumer Financial Protection Bureau. Now, last week, I believe we went over the Dodd-Frank Wall Street Reform Act and we hit the CFPB. And what sections of Dodd-Frank created the CFPB was Section 10. Remember, the Dodd-Frank Wall Street Reform Act created the CFPB, and the CFPB is the chief federal level enforcer that oversees many of our legislation in the mortgage industry. The next question: what factors must lenders consider under the ability to repay rule? The ability to repay rule that we've been talking about here. And the answers to this is these are the following factors. There are 8 factors that lenders must consider under the ATR rule. ATR is the ability to repay rule. We have to make sure we're looking at income and assets, employment status, monthly payments, simultaneous loans, any other loans that are going into the qualification standards, like maybe they're taking a seller first and a second to be a sort of a jumbo buster to avoid PMI, or HELOCs. They're getting a line of credit in addition to that. So we're looking at simultaneous loans. Related obligations like taxes and insurance, current debt obligations and current debt load. What is their existing DTI? And then their credit history and other insuring borrowers that they can repay. So we want to make sure that we're looking at this comprehensive factor. Now, I'm going to tell you, you'll get into the business and you're going to find that a lender will make a loan to, let's say, somebody that has a trust fund, for example, and they have a large amount of liquidity, and they have that. They're not looking really intently at the employment history. Maybe they're looking at the asset. So again, you're looking at asset dissipation versus something else. And you have those factors, and you're not going to be shocked. You're going to find that lenders are making loans. Now, can you make a loan on a risky basis? Can you make a stated income loan? Can you say, I don't need to verify income. They have plenty of assets. And the answer is yes, you can. What happens, however, if you steer as a lender towards a qualified mortgage, you make a safe loan, you follow the QM rules, you make sure you're checking off the ability to repay. If you do all of these things as a lender, think a lender now visually is a large boat, right? Like a boat. And they're out to sea. And there's a storm coming, right? A big hurricane. Let's say that hurricane is hurricane foreclosure. And this foreclosure hurricane is the homeowner defaulting on their loan and not able to repay. Now the lender's making a bunch of these loans. And now this hurricane is intensifying. It's getting stronger and stronger. Lots of defaults are happening. People lose their jobs, blah, blah, blah. All of these bad things start happening. And all of a sudden, loans go into default. Now, the lender decides their remedy for default is, hey, look, pay us back, or we can foreclose on the lien and we can sell the asset to get our money back, right? So that's like a fail-safe. That's the emergency ripcord on a parachute for a lender. Hey, if you don't pay us back, we have equity in the home and we can sell the house and get our money back, and then whatever's left over we'll give you, right? So they have recourse in that regard. However, if a lender makes non-QM loans, then their rebuttal presumption, there's a fancy phrase that you're going to see. You won't see them on the exam, but you need to understand this concept. It's called the safe harbor rule. If a lender makes QM loans and follows the ability to repay checklist, then if there's a default, then the lender will be cleared to go and foreclose on that loan because they've done everything that they can to go ahead and verify that they're going to get paid back, conventionally speaking, of course. And then the courts are going to allow the foreclosure to continue. However, if they don't make QM loans, then this rebuttal presumption doesn't exist, and the lender may lose their right to foreclose on that property and may have to eat the loan. All right, so there's a danger here, and this danger is, hey, listen, we're not going to bail you out from this. If you make bad loans, then you're going to fail and you're going to go out of business and you're going to be in big trouble. So the idea here is that we want to make sure there's safety features. If you're doing the safe stuff, then you're going to be okay. And then there's the ability to foreclose, and it gives you these remedies and everything else. So there's a safe harbor rule. Think of like a boat, the lender on the ocean, and a storm's coming, this massive hurricane, and you need to get out of the open waters. You need to come to closer to shore, and you need to dock your boat. The safe harbor rule says make good loans, and if bad things happen, then you can go after them with foreclosures and everything else. You're not going to be vilified for being the big bad lender that made bad decisions. And if you do make bad decisions, then this is all on you. We're telling you what we think you ought to do in terms of the framework, and if you follow the framework, not only do you open up loans that can be sold to Fannie Mae and Freddie Mac and have a robust secondary market, but because we want to buy safe loans as well. And that's how this whole game works. All right, so that's the ability to repay rule. I also threw in the safe harbor rule. Let's hit a question. Which of the following scenarios would violate the ATR rule? Letter A, approving a loan based on a borrower's verified income, excluding income from an unverifiable side job. Letter B, calculating monthly payments on a loan with an introductory interest rate using the fully indexed rate. Letter C, ignoring monthly payments on a simultaneous loan that the lender became aware of during underwriting. Letter D, denying a loan because the borrower's debt-to-income ratio exceeds 43%. And the answer? Letter C. So which of the following scenarios would violate the ATR, the ability to repay rule? Letter C, ignoring monthly payments on a simultaneous loan that the lender became aware of during underwriting. Okay, so we just understanding what they would. Approving a loan based on a borrower's verified income, excluding income from an unverifiable job. Nope, that's fine. Calculating monthly payments on a loan with the introductory interest rate. You want to make sure you're using the fully indexed rate, as a matter of fact. And denying a loan because the borrower's debt to income ratio exceeded 43%. Remember, they can go past that number, and they're still fine. Next question. How do origination fees affect APR, and why does APR differ from the interest rate? So on your exam, per the Truth in Lending Act, implemented by Regulation Z, right? You want to know that one of the big fundamental pieces is APR, annual percentage rate. And for the loan origination students, you want to understand a little bit more about APR, like finance charges. Learn a couple of examples of finance charges, and learn a couple of examples of things that are not considered finance charges. And then, so once you understand that, also understanding that the APR can be advertised with no other clarification. It is the clarification. So I can advertise an interest rate, but then that's going to trigger me to advertise the APR next to it. I can advertise the APR, and that's all I need to do, and I'm within full compliance. So I can say mortgage rates with 3.1412 APR available, 30-year fixed mortgages, that's fine. But if I say 3% mortgages available here, that's only half the story. Now the question is how much is it going to cost to do business with that bank to get that 3%, right? So again, so 3% is very low right now, right? So that's I would go, hey, well, what's the catch? Is it a bait and switch? Am I going to get 6.875 closer to where the market is today? But there's a bait and a switch here. There's an introductory rate for 2 months, and then it goes up. What's the catch? And that's what the APR is looking to do. It's to catch and clarify what things are. Okay, so how do origination fees affect APR, and why does APR differ from the interest rate? Well, then, what we do is we say the APR takes into account not only the interest rate, but also any upfront fees like origination charges, meaning that a higher origination fee will result in a higher APR, reflecting the total cost of borrowing over the life of the loan. So what we're trying to do with APR is this is sort of, how do I compare Bank A to Bank B? All things being equal and considering that I am qualified to borrow, how does a consumer compare shop, price shop, if you will, between Bank A and Bank B, right? Between, let's say, a JP Morgan Chase and a Bank of America or the Bank of Opportunity, right? Whatever the hell they call themselves. So the reality is many consumers are going to call mortgage originators up and say, hey, what's your rate for 30-year money or something like that? And you're going to look at your sheet and you're going to say, we can offer you 6.875. Well, one of the problems is quoting interest rates is sort of, you're kind of setting yourself up to almost be fake because you don't know everything that's going on with that particular consumer. You don't know what they would qualify for. You don't know how much income they're making. You don't know if they're about to lose their job. You don't know all of these different factors. You don't know what their credit score is. You don't know any of these things. So many times what originators err, and this is a mistake, is they quote a rate. I think my opinion is you should never quote a rate until you have a full picture. Obviously, you want to make sure you know. Now, many times you'll still be pushed to try to quote rates. Now, you quote a rate, and then they call up the next bank, the consumer, and then they're quoted another rate. Like this is this pervasive issue, and it's all rate quoting. But the reality is an informed consumer should really be asking, hey, what's your 30-year rates, and what are the APRs connected to that rate? What is the APR? So let's say if it was, I'm just making some numbers up, let's say if the rate was 3.125 and the APR was, that's a 1, sorry, 3.472 APR. And then you call a Bank B, and Bank B says, hey, we can offer you 3.125 as well. Okay, well, what's your APR? And then they say our APR is 3.312. I'm just making that up, APR. So now, which is a better deal? Well, they're both offering the same interest rate. And what a consumer typically does is they go into this death spiral of like calling up 10 banks and getting the same rates. And now it's confusing, right? So what they need to do is go one step lower and go, oh, per the Truth in Lending Act, what's the APR? And the APR is this. And now sometimes what people do is they misquote purposefully, loan originators, the APRs to try to get people in, again, bait and switch them because they can offer them that rate, but the fees and the charges might be more. So Bank A might make more money on their 3.125 loan compared to the Bank B. Now, what does this net effect is? Well, you're paying closing costs for borrowing money. So if you're looking at it in terms of the debt service and the expense of the debt service, it's like the difference between two credit cards. One credit card might be, 0% balance for the next 16 months. So pay off your debt while you're not paying any interest on it. Well, what are the application fees? No application fees. Wow, that's a great deal if you have the credit rating instead of going and paying another lender all kinds of rates, fees, application fees. So the net effect is you're borrowing money for more money. It's more expensive to borrow that money. So that's the logic of APR. It's a great question. I've been asked this. I can't even tell you how many times I've been asked that question. And then a less of a significant question, I'm not going to really heavily go over this one here, is what is the difference between APR and APY? And that's really something that I don't think you're going to see on the exam. It's been asked of me, and this got made the cut. Why is APR used in mortgage disclosures? And that's probably more of the appropriate piece of this question. And APR is used in mortgage disclosures because it focuses on the borrower's costs, while the APY focuses on the lender's return. So the annual percentage yield, which is what APY stands for, I wouldn't even think about that. Don't even fill that into your brain stems for this examination. Kick that free. And I would just focus on APR is utilized because it's really reflecting what the cost of credit is for the consumer. So this is you can even remember it as the true cost of credit. Question: when reviewing a loan estimate disclosure, the borrower notices the APR, the annual percentage rate, is higher than the loan's stated interest rate. What does this indicate? Letter A, the loan includes additional fees and costs such as origination fees that are factored into the APR. Letter B, the APR reflects the lender's effective return, including compound interest. Letter C, the interest rate on the loan is variable and subject to increase. Letter D, the borrower will pay compound interest over the life of the loan, increasing the effective rate. And the answer? is letter A. The loan includes additional fees and costs, such as origination fees, that are factored in to the APR. And again, APR is one of those items that you definitely want to know about per the Truth in Lending Act for your exams. Okay, let's talk about this safe harbor rule a little bit more. And I kind of talked about this earlier. I just wanted to show you the slide here. The safe harbor rule, again, comes back or dovetails into the ability to repay rule and the qualified mortgage rule. So safe harbor protects lenders from legal liability if they follow specific guidelines and meet the qualified mortgage standards, ensuring compliance with the ability to repay rule. Essentially, when a loan is deemed low risk under these rules, borrowers cannot claim that the lender failed to make sure that they could afford the loan. So there is an argument that a borrower can make if a lender writes a risky non-QM loan. And the borrower could say, listen, I shouldn't be on the hook for this. They should not be allowed to take the home because the lender failed to make sure that I could afford the loan. They didn't have any litmus tests. So shame on them. Let's stay the foreclosure. And so the safe harbor rule is just that. The safe harbor rule is really made to protect lenders. Okay, and it's to make sure that they have this rebuttal presumption baked in. If you follow these rules, then you have the right to foreclose. If you don't follow these rules, then a borrower can bring a claim that says you failed to make sure that I could afford to pay this loan, so therefore you cannot foreclose on this loan. All right. That was our Q&A session for the exam breakdown, the NMLS version. We usually do them on Wednesdays. It is a pleasure to be working with you and studying. If you guys have questions, put them in the comments. Thank you very much for checking us out. Please make sure to subscribe if you already haven't. And if you have, thank you. Man, thank you very, very much. Our channel is doing excellent. We're growing. Please give us comments of the new materials that you'd like us to check out and maybe put together. I will do something about the redisclosures and the cumulative redisclosures, the 10% and what can be zero tolerance. I promise we'll put something out when time permits us to do so. It'll help all of our students make sure. If you know someone we can help, make sure you refer them to this channel, have them subscribe. They won't be sorry. We've got lots of cool stuff coming out for 2025. We've got a lot more NMLS mortgage loan originator materials for study purposes that are coming out, and a lot more really cool things around the corner. We've got books and materials and content if you need extra help, and we're happy to be here working with you. So study hard, study well. If you have any questions, reach out to us. Thank you for the comments. Thank you for everything. Thank you for your support, and we will see you in the next one. See you next week. We do exam breakdowns on Mondays and Wednesdays, by the way. And on Mondays, we're working with the real estate professionals, the brokers, and the salespersons all over the United States. And on the Wednesdays, we're doing the NMLS mortgage originator stuff, again, for everybody in every state in the U.S. This is going to help you get through these exams. We look forward to making that help, and we'll see you soon.